Hello everyone, welcome to Just Invest Today, and today we're going to be talking about the book called Richer, Wiser, Happier by William Green. And guys, if you haven't read this book, please go read it. It talks about everything from investing to life to your mindset, all that good stuff. And this is going to help you on your investment journey. So go read this book if you haven't read it. And in today's video, I want to talk about the Nick Sleep chapter. I feel like the Nick Sleeps chapter is so important because it highlights and then establishes that huge good mindset. So I want to talk about some quotes in his chapter in this book. And just a little bit of background about Nick Sleep. Nick Sleep averaged 20% a year. I think from like around 2001 to 2014. Guys, if you're averaging 20% a year, you're doing amazing in the market. And think about it. Compare that to the S&P that does like what? 8%, 7% yearly if we're just going to do it all over from year to year. So 20%, you're going to compound your money very fast, right? So I want to get into some quotes about what Nick Sleep said in this chapter and how this can help us on an investment journey and how we can make sure that we're compounding our money without any struggles and without any lapses in our judgment. So let's get into this video. Before we get into the quotes, I'm going to do a little background on Nick Sleep, a little tiny background. If you want more of his background, you can actually read the book. But first of all, Nick Sleep, right? He graduated from university and then he wanted to do like landscaping and architectural work. And then he found out it didn't last in his field and it wasn't good pay. And the things that he thought it was going to be, it wasn't, right? So then he kind of just fell into some investment role and he did that. And then he went into another investment role. And then after that, the investment role that he was in an investment firm, he was trying to get the person to actually split it so he can have his own fund. And that's when they start, and this was in Marathon Fund. So when the Marathon Fund actually approved of him splitting it, he called it his own partnership and it was Nomad Partners. And that's when he got Zach, and Zach was his business partner. He found Zach in like another investment firm back where he met him, right? So after they got Nomad, and guess what? This was after kind of like 2 years or a year after the tech bubble of 1999. So if you really think about it, they got in at a perfect time in the market to kind of like get into the market because the tech crashes happen. So stocks are very cheap and stuff is happening. It's the same thing as getting into the market during the March 2020 lows during the whole pandemic crisis. Guys, if you got in the bottom, if you called the bottom, probably not everyone did, but if you did, you had huge returns. I hope you got in just like I got in, but still, you made huge returns because, guys, that was the lowest point, and that's when you're gonna make the most money. So think of it like how they did it in 1999, 2000, 2001, in that time frame. So guys, let me get into this video and get into some quotes that actually helped me in this investment journey. Disregard all the ephemeral information that distracts investors from what matters. Sleep notes that information like food has a sell-by date, but some of it, especially perishable, while some has a long shelf life. This concept of shelf life becomes a valuable filter. For example, I spoke with Sleep and Zachariah again in the May 2020. The financial news was full of speculation about the near-term impact of the virus on consumer spending, corporate profits, unemployment, interest rates, asset prices. An article in the Financial Times even debated whether the U.S. economy recovery might resemble a VUWL or Nike swoosh. To Sleep and Zach, this fleeting news coverage was all part of the daily soap opera of the market, too superficial, short-lived, and unreliable to hold their attention. They couldn't predict how the economic news would unfold, so why waste mental energy on the unknowable? All this short-term economic data is not important, guys. Nick and Zach feels like should be all entertainment. Think of it as just all pure speculation and entertainment and just focusing on investing in great businesses. Make sure you put all that data into the entertainment section. He even talks about EPS junkies, all the guidance estimates. All of that stuff is just to get you to be active in the market. And that's what Nick and Zach see, And that's how they try to avoid all that information. And they talk about just focusing on 10Ks, what management is saying, all that 10 Qs. Just focus on that. You don't even have to focus on the quarter results. If you think a year or two from now, do you think that quarter to quarter report is going to be very that intriguing or interesting? Or if it hits that EPS estimates? No. So that's how Nick and Zach actually filter out their information and they keep a steady focused state. Sleep and Zach played what they viewed as the long, simple game, which involved buying a few intensively researched stocks and holding them for years. Their slow and patient, deliberate strategy was so counterculture that it sounds almost quaint. We cannot for the life of us figure out why society at large is served by having company owners swap seats every few months, wrote Sleep. The basic building blocks of society is broken when those with their hands on permanent capital change their minds with their underwear. Nomad would succeed by taking the opposite approach. So guys, the opposite approach is Nomad. It's Zach and Nick. They're holding their stocks for years and years. They want to hold it for 6, 7 years if they can. And they don't think about a price to sell. That's their objective, just to hold long as the business is improvement. In this book, William Green talks about when Jeff Bogle started in the investment business in 1951, the average holding period for stocks was around 6 years for mutual funds. Since 2000, the average holding period has been 1 year. Guys, how much in 1 year can a business actually improve and actually profit? Just 1 year. All that is just speculation and hoping your investment goes up. Guys, you gotta think long term. The longer you hold the stock, on average, the better you'll do because the business has time to improve and get better. And that's gonna show in the long run as long as you're holding a quality company. So let's get into the next quote. Once Sleep and Zach understood the magic of this one business model, they made it the overriding focus of their fund. Their attraction of cigar butts waned and they concentrated instead on the handful of companies they shared with economies of scale with customers. That's the best single thought you may have ever had in your life, says Sleep. It needs to dominate everything because you're not going to get many insights like that. And everything else is a bit low quality. Guys, when we think about this quote, we gotta think about it like they're just singularly focused now. They found their highlight of their life and they use this to make the best investments going forward. Economies of scale is an amazing insight that they found as when companies get bigger, get larger, get more efficient, companies that share those resources with their customers, making their cheaper prices, that just generates more customers coming in, getting lower and lower prices. And that's a huge moat for the company. And once they found that, they made sure they only invested in companies with that mindset, like Amazon, Costco, and a few other companies like that. So, guys, when you maintain that focus on a singular aspect, it can be sometimes very good, and that just makes your circle of competence even stronger. So that's one thing that you can learn from this book as well. And I'm gonna go into the last quote. It's all about deferred gratification, says Sleep. When you look at all the mistakes you make in life, private, professional, it's almost always because you reach for some short-term fix or sort of short-term high. And that's the overwhelming habit of people in the stock market. The tendency to trade too frequently, to make emotional decisions based on alarming or alarmist news stories, to join the herd in changing after the most popular and overpriced assets, to dump funds that have lagged for a year or two, or to sell winning stocks prematurely instead of leaving them compound for years. Sleep and Zach are titans of impulse control. How else could you hold Costco for 18 years and Amazon for 16 years while it soared from 30 to more than 3,000 per share? They understood the fundamental truth that we benefit from deferring gratification and prioritizing long-term outcomes. Guys, I know that's like the hardest thing we can do in the market. It's so hard for us to see 50% drops, and maybe that drop will stay there for a year, and we have to defer that gratification of selling that stock and maybe seeing what other people are gaining in the market. I know it's super hard, but guys, if we want to make these long-term investments, these long-term gains, we have to be able to defer the gratification of kind of making money in the market. So guys, tell me what you think about this video. If you like it, please share it, like, subscribe to the channel. I'll get back to you in the next video. Peace.